The final probability increaser that we can use for supply and demand zones is the concept of mitigation. And what is mitigation? It's essentially price tapping into a supply or demand zone and seeing the series of that phenomena occurring. So what we know is we have a sweep of liquidity, a break of structure that improves the quality of a supply zone that we're seeing. Now, if we start to see price tapping into a supply zone, we would consider that a mitigation, and what we'd expect is price to then move to the downside. And what we can see in this example is we've swept liquidity, we're breaking structure, and more importantly, breaking the swing structure. We now have formed another supply zone, and then price can continue moving to the upside, tap into that or mitigate, and then price then moves to the downside. What we can see, break structure, take liquidity, mitigate. And this can happen multiple times, and this is another way that we can start to improve the probability of our trades. So in the previous videos, we said that improving the probability of a supply or demand zone, we'd be looking for a break of structure, a sweep of liquidity, and now we're going to add on the concept of mitigation, and it's a form of improving the supply and demand zones and the probability that they will actually see price respecting them. So what we can see, if we move back to our examples again, this one is a little bit less common compared to break of structure and sweep. So if we're looking at the combination of these probability increasers, we would have in order of succession that we would see. Number one would be a break of structure. More often than not, we're going to see a break of structure. Number two would be a sweep of liquidity. And then number three would be the mitigation. The mitigation is more of a read between the lines sort of phenomena that we could use, where we may only see a mitigation of a zone that creates a supply zone. And it may break structure, but that might be it. It might not break structure either. So we need to read between the lines a little bit. This is where things get a little bit convoluted, which is why it's a probability increaser, but I personally wouldn't just look at mitigations in isolation for validating a point of interest. So if we look on the 15-minute here in the examples that we've been going through, what we can see is that we do have what looks to be a demand zone. We break structure, so in theory this is valid. We break structure. So we can look at that, and what we can see is price does in fact tap into that. We have a mitigation of this demand zone because again we broke structure. And then when we were looking at this zone, we can see that we swept liquidity, and we broke structure. So this makes this zone even stronger based on that information. So if we just look again, what we can see is we do have a little bit of structure break. We create a demand zone, but it sweeps liquidity. We don't actually end up mitigating anything. So again, not much happens in the way of improving the odds using the concept of mitigation. Then what we can see is if we just move on, we get equal highs, we get a tap, we mitigate something because we've swept liquidity. We haven't actually broken structure. So again, this is where things get a little convoluted, but we can look at this in a different lens. So let me just zoom in to make this a little bit clearer. So what we can see is if we just look at this, we can see that we took out the external range liquidity of this high, and then we got our pullback. We can say that on a lower time frame, this would more than likely be a break of structure. So we can start to look at it in that lens. Where did we break structure, or where did that come from? More than likely this inside bar, which would be a demand zone. Now, I wouldn't recommend trading the reaction of this demand zone, but what we can see very easily is that price respects that, it mitigates that demand zone, and then that's where we get the sweep of liquidity, the break of structure, and we're able to use that as our demand zone. And then if we just continue moving on, we can just see that, again, we have a break of structure, very minor break of structure, again on the lower time frame. We have demand zones that rest in wicks, and then price continues moving to the upside. We get a little bit more of a confirmed break of structure, sweep of liquidity. We have a little bit of a demand zone. We have a little bit more of a demand zone, some inducement, and then price does react off of it, but we don't see a follow through. Similar to this situation, we see that price hasn't actually mitigated anything in this area, but what we can see, if I just move this over, we can see that price mitigates a higher time frame point of interest. So I'll just move this back over one more time, move that right there, and what we can see is price takes liquidity and then moves to the downside. We could argue that on a 1 minute that this is structural break, so we do have a break of structure, but more importantly, we have a mitigation and a sweep of liquidity. And what we can see in this wick, we have a supply zone, we tap into that supply zone, and then we continue moving to the downside. if we look at this zone, we also, like we had mentioned in the previous videos, that we have this, which is just a pivot supply zone. You can see that we mitigated this. We created that pivot supply zone. We've mitigated that, so we're just adding in the concept of mitigation. But again, we know that this doji is a range on a lower time frame, therefore it's probably a higher probability. This mitigation is a lot more proper. This zone leaves a little bit to be desired, and as we can see, if we just move on, we get that slight tap. So more specifically, we probably did tap into something more so like that. As we can see, we do tap into it. So however you look at that supply and demand zone, the logic is still there. We've mitigated this wick, we've broken structure, and then we've mitigated this, which adds a mitigation to that. This is still a valid point of interest because we haven't actually tapped into it fully. We get a little bit, like I said, which is why price would gravitate a little bit higher in there. And then if we just use our bullish example again, sweep liquidity, break structure, mitigated this area right here. So what we can see is we've mitigated a demand zone to the left, this one right here. We've swept liquidity and broken structure, therefore it is a valid point of interest. What we can see is price never actually gets to that point of interest. We have this area right here, which just breaks structure. And then we continue moving on. So we're moving between this range. We haven't seen any mitigations that are warranting anything. Price then continues. We tap into all of these zones. And then we can just move into this little bit of information. You can see sweep of liquidity. We do have this particular zone, but nothing taps into that. We can start to see break of structure. So we can see valid point of interest that we could look at. Mitigation, which would bring us to here. We break structure right here, we break structure right here. Therefore, this would be a valid supply zone. Then we can see that we break structure here, and this point does in theory mitigate this, but we don't actually break structure. So again, if we're looking at this little bit, so we'll just go back. So we broke this structure, therefore it validates this POI as a supply zone on a lower time frame. We get that mitigation, and then price continues moving to the downside. What we can see is we do move to the downside, but we don't actually break any true structure. We sweep liquidity, so let's just move that. We sweep liquidity, and we've mitigated something. And then what we can see is price mitigates this wick. We break structure, and then we create a supply zone. So we have sweep of liquidity, we have a mitigation, we have a sweep of liquidity, we have a mitigation of this, and then we have a break of structure. Therefore, this is a fairly high probability zone, but what we can see is then we move to the upside. We tap into more of this area before we continue running to the downside. But again, we're just trying to understand what's happening here to put ourselves in the best position. We could have taken a trade here, and there's nothing wrong with that, because how would we have known that price was going to come up higher and interact with whatever is resting just above? Because we wouldn't actually know that price is going to move or pop up to the upside. The only indication that we could have is when we look at the concept of internal range liquidity once more. We know that we have a lot of swing points in structure. What does this end up creating? Creates a lot of liquidity that's resting there. We have that liquidity void, so we know that chances are price is probably going to fill that to a certain regard. So we're able to look and say that all of this has been mitigated, so chances are something up in here would make sense. Again, I would be more poised to look at this wick, which we never actually tap into. So that would be a missed opportunity, more than likely on my side. But again, this is where we start to look at the 1 minute, and we can start to see price reacting off of these areas. See if there is something that would rest within here to look for entries. It's getting a little bit more involved or a little bit more in depth than what I want to do in this video. But again, it's just explaining that we would not have really known that this was going to pop to the upside. The only way we would be able to really figure that out or have an indication that it could happen was, one, that we have all of this structural liquidity right here, and the fact that we haven't actually tapped into this supply zone as well. And we're starting to create relatively equal highs, structural highs that then we see getting swept right here. And now what we'll do is we'll just go back down to our 1 minute example that we've been going on in the last two videos. I'm trying to showcase the same examples just to show how we can add on these probability increasers to just understand what we're seeing on the charts, and that way we can make sense of everything that we're seeing. So now if we look at that first trade again, we have that sweep of liquidity, the break of structure, and what we can see is the first supply zone doesn't really get interacted with. As we can see, price then moves to the downside. We take liquidity, we create a supply zone, we break structure, and we take liquidity, which is why this is a valid supply zone. And what we can see is this supply zone right here is valid because we take liquidity, we break structure, and we mitigate a previous supply zone. Then we move on to this supply zone, which we can say we did sweep a little bit of liquidity, but it's definitely not as proper. We did sweep some liquidity here, so the option is there for you. It's not as clean, but what we can see is, what do? We break structure and we mitigate this supply zone. Therefore, a valid supply zone that increases probability because we have that break of structure and we have that mitigation of a previous supply zone. Now again, if we look at this, we have a break of swing structure. We have this inside bar, we have inducement, price taps into it and runs. And what we can see with this one is we take liquidity, we've mitigated this and we've broken structure. Therefore, this should be a valid point of interest. It holds and then we continue moving to the downside. And what I can do is I'll just drag this over, although we know that it was more or less we'd be interacting off of this zone. But we can see with this supply zone as well, we get that change of character, that sweep of liquidity. Again, minor break of structure. So whether you're going to classify that, but again, this is why we're explaining this bit on why this is still a valid area that you can choose to trade. Why? Because we swept liquidity. We did break some structure. Again, arguably, if we broke structure, yes, on the seconds time frame, 1 minute, not so much. But more importantly, what did we also do? We mitigated a previous supply zone. So we have extra factors in our favor to look for a potential trade. We also have that level of inducement to look for an entry. It improves our overall probability of that supply zone trade playing out. Again, when we look at this one, this gives us more confidence to take this particular zone. Why? Because we broke structure, we took liquidity, and we mitigated a previous supply zone. Therefore, this looks to be a great point of interest or supply zone to look to trade. We move on to the next one. We take liquidity, we mitigate a previous supply zone, we break structure, we break structure, we break structure. Very great looking supply zone to look for future trades to be taken. Move on to this one. This one does not mitigate anything. We just sweep liquidity, tap in. What we can see at this one, we don't take liquidity, nor do we really break structure. Therefore, this point of interest that would be created more or less from this doji, not the highest probability. Why? Because we're not seeing any true commitment. We're not seeing a sweep of liquidity. We're not seeing a real break of structure that's created from this. Yes, we do have a small break of structure here. We create another break structure. It would push us to look here. Have we mitigated anything from here? Arguably, no. Yes, we have this, which is our pivot supply. We did break structure, but again, we're starting to look at small little details, but we're trying to look at the overall swing structure. And again, this is where it comes back to critical thinking. What is this? This ends up being internal range liquidity. We have a point of interest that rests above it that has all the confluences that we need. Break structure, break structure, break structure. Mitigate something to the left and sweeps liquidity. Now we're just trying to wait for price. Now we're just being patient and waiting for price to return back to that. And now we're starting to understand liquidity that is being dropped for the purpose of inducing to tap into that particular zone. And then what we can see if we just move on to the demand zone side of things, now that we know that price does in fact react off of this, we have sweep of liquidity, break of structure that changes trend. We're reacting off of a higher time frame demand zone. We tap into this, great. Now that we have our mitigation, we sweep liquidity, we break structure. This area right here has all the probability that we need, that chances are this will be a valid trade. And what we can see is price does eventually react and respect that zone. Now, if we look at this bit of price action, what we can see again, just a break of structure, a little bit of a sweep of liquidity, but the sweep of liquidity in my mind is a little bit convoluted because it's a little bit different on how this demand zone came to fruition. So not so much of a great or valid point for me to look at. What we can see here again, break of structure, sweep of liquidity, we create this POI. Now we have this point of interest that breaks structure, sweeps a little bit of liquidity. We have a mitigation. We have a mitigation of that zone, but ultimately this does not hold. Why? Because we're creating internal range liquidity. So we'd be starting to look for different points on a lower basis to look for entries, but there'd be nothing wrong with looking for an entry here and looking for an entry on this wick. If you were looking for something on this, then that's when we have to start running through our probability increasers. Yes, it does break structure. Does it mitigate anything? No. Does it sweep liquidity? No. That's why this area does seem a little bit more high probability. We sweep liquidity, we break structure, we mitigate a previous demand zone. And that's why, if we just zoom in and look to the right of this wick, that's why we do get a small reaction, but then eventual fail in price action. And now we can move on to this supply zone. Again, sweep of liquidity, break of structure, valid supply zone. We also have a mitigation of a previous supply zone, therefore higher probability supply zone being formed. And then we move on to this one. Again, we said we don't really have a sweep of liquidity. We really just have a break of structure, and we have inducement below. This one, we have sweep of liquidity, break of structure, mitigation of a previous demand zone, which is why this wick is a very valid demand zone to look for buys. And then one other thing that we'll just go over is a little bit more recent price action right here. And what we can see is when we're looking at a change of character, we're tapping into a higher time frame demand zone. So we know that the likelihood of price potentially looking for a reaction to look for buys and maybe even reversing trends to start putting in higher highs and higher lows on, say, a 15-minute and 4-hour chart start to increase. So now we're just looking for reasons to look for entry. So these red lines are a change of character on a 15-minute. But what we can see here on the 1-minute chart is as price comes to continue down, we react off of a demand zone. This demand zone sweeps liquidity. It breaks structure. We see that price does get respected. We get another tap into it. If we're looking at this as a demand zone, has it broken structure? No. Has it swept liquidity? Arguably, no. Has it mitigated something? Yes. Therefore, it is valid. But then what we can see is when we react off of it, we get a slight reaction. What are we dropping? We're dropping equal lows. What is likely to happen? We're going to break to the downside. We also see these structural highs. So chances are internal range liquidity for future use. And then what we can see is we break to the downside. Then we start to move to the upside. We get a reaction to the upside. Have we broken any structure? No. Have we swept liquidity? Yes. Therefore, valid POI. Would you look to trade that? Probably not. That's pretty aggressive to look for a trade there, but we're starting to use that as a basis. Now what we can see is this point right here. Did we break structure? Yes. Did we sweep liquidity? Barely, but yes, we did. And have we mitigated something? Yes, we have. Okay, now we're starting to see valid, very valid points of interest, demand zones taking place. We're starting to tap into, again, a higher time frame point of interest. Now we can see this point of interest, whether we use the inside bar or the inside bar plus the wick or just the wick. If we're using the wick, we can see that the wick doesn't get respected. When we're on the 1 minute, I tend to include the inside bar plus the wick just for consistency purposes. I mean, at the end of the day, the zone itself is only about 2 pips, so it's not the end of the world. But what we can see is, do we break structure? Yes. Do we sweep liquidity? No. Do we mitigate something to the left? Yes, we do. Okay, valid point of interest. Move on to the next point of interest. We can see, do we break structure? Not really. Yes, this inside bar is indicative of a range on a lower time frame, and more than likely on a seconds time frame that would be a break of structure. So yes, we could argue it is a break of structure. Is it a clear 1 minute break of structure? No. Does it take liquidity? Not really. Yes, we have some lows here again on the seconds chart. We could classify those, but we're looking at 1 minute structure. Does it take liquidity? Not in a formal sense. Does it mitigate something? Yes, it does. Therefore, valid point of interest. And we continue on looking at this. We have a push to the upside. Do we break structure? No. Do we take liquidity? No. Do we mitigate something? Yes, valid. And then we continue on. We can see that we have this wick now. Do we break structure? Kind of. Again, this is lower time frame structure, but we're starting to wick structure. We're taking out the liquidity of this. Have we taken liquidity? No. Have we mitigated something? Yes. Therefore, it is valid, and we can continue that process. But again, this is why we stack our probabilities in our favor, because what we can see is in this instance, yes, we did mitigate something. Yes, we kind of broke structure. Does that sound like we should be taking a trade? No. But what it is framing our minds up from a logical perspective is we're starting to see order flow taking over. We're starting to see respecting of demand zones and price continuing. But on the flip side, what is that also showing us? Price hasn't really moved. We haven't really seen a huge move to the upside. When we're starting to see demand zones getting respected and that process of mitigation taking place, we should start to see large moves to the upside. And what we can see is if we just scrunch the chart to the upside, we do consolidate for a while. But what we can see is we have a demand zone here. If we look here, again, we tap into it. We've broken structure. We can see that we've actually broken true structure. All of this is more minor structure until we break swing structure on the 15 minute. That's our true change of character on the 15 minute. We tap in. So we have a mitigation. We break structure. Do we take liquidity? No, we don't. But that's okay. Then we can look at this bit. We take liquidity. We break structure. We create a valid point of interest. Yes, we've mitigated something to the left. Can we use that as a valid point of interest? Yes, we can. We can see it does wick lower about 0.7 pips. So whether we stay in that trade is a whole different story. But again, valid point of interest. And we can just keep going and looking at this process. But the biggest and most important thing to understand is using these probability increasers for supply and demand zones, breaks of structure, sweeps of liquidity, mitigations. If we can combine all three, we can create high probability trade ideas. We don't necessarily need all three. And again, like I said, you'll see that breaks of structure and sweeps of liquidity are a lot more common than mitigation. And one thing we need to factor in as well with mitigation is sometimes when we get too many mitigations, we start to create structural liquidity. So we need to be careful. But if we start to see large moves away from that, then what we can assume is that process of mitigation was an accumulation of orders to then start changing momentum. And again, when we've seen this where we took out liquidity, we broke structure, we mitigated something to the left, this is a valid point of interest. And what we can see is we do get a proper respect of it. But then what we can see is the tap into it creates more internal range liquidity in the form of equal lows. Therefore, sell side liquidity is more than likely resting below these. And what do we end up getting? We get a sweep of that liquidity, break of structure. We tap into that. Yes, we could argue that this is just mitigating this area as well. But more importantly, we sweep liquidity, we break structure. And it gives us an opportunity to use this as a future point of interest. We haven't actually seen anything happen with this point of interest. But then what we can start to see is we break structure. We can start to look at these areas and we can see price run off to the upside eventually when the momentum takes over. But it's looking at that sort of price action and understanding what's going on behind the scenes, how price is interacting with supply and demand, how we're interacting with liquidity, how we're interacting with market structure, things like that to build high probability trade ideas. It's all about reading all of the clues, looking at information. If you're looking at a trade and you're like, well, it's kind of mitigated, well, it kind of broke structure, well, it kind of took liquidity. If you're not certain about it, just don't take the trade. Use it as a probability increaser for your next trade, because if you get a kind of break of structure, a kind of mitigation, and a kind of sweep of liquidity, but you're not sure whether you'd enter it, don't enter it. Wait for price to return to that area. Say, okay, is price going to respect it or not? If price does respect it and say we get a true break of structure, a true sweep of liquidity, and a true mitigation, or the combination of two of those or just one, then you can start to say, well, I know that we're seeing the process of demand being respected, for example, and that first zone was a little iffy for me. I didn't have that warm fuzzy feeling, but now that I'm seeing all of these factors playing into the next zone, that gives me more of an indication that price will respect that zone. But again, we are factoring in the higher time frame market structure. We're understanding the concept of internal versus external range liquidity and supply and demand to combine all of these into a convenient package to understand what's happening behind the charts. Because if we don't understand market structure, we can't understand trend. And if we don't understand trend, we don't understand the direction. If we don't understand supply and demand, we don't understand the concept of fair exchange or buying and selling, which is causing the imbalance in the markets where large orders are being placed. And if we don't understand liquidity, we don't fully understand where pockets of orders are resting within the market. And if we don't understand that, we don't have a strong indication of where price is likely to move before we see true moves when we're balancing the order book. And if we don't put all of these concepts together, we can't frame up high probability trade ideas that go in the direction of the higher time frame. We're not putting ourselves in the best position for looking for entries. We're not being targeted as liquidity because we're entering too early. So what I would recommend for all of you to do that are watching this video now is, again, go back to your charts, look at mitigations, look at price returning back to supplier demand zones and creating new supplier demand zones and seeing the power of that, whether it's for actually taking trades or just starting to build confluence for order flow to be built. Because as I said, when we were looking at this little bit of information, we were starting to see a change of character before we got the change of character on the 15-minute chart, but we were able to understand what was happening on a 1-minute time frame. We were able to see the order flow switching from bearish to bullish. And while some of these points of interest were super aggressive and didn't have a lot of confluence, as we start to see them building up, it gives us more probability to start looking for trades. So if we didn't take this one, that's okay, because we didn't really have any indication. If we didn't take this one, because again, we didn't have a whole lot of indication, that's okay. If we didn't take this one because we didn't have a whole lot of indication, that's okay. We start to see our 15-minute change of character. We're starting to see impulsive nature into the chart. Then we can start to build trade ideas within this bit of price action, because now we're starting to see that picture come alive. We don't have to be the first into any trade. We can just stack probability in our favor and make the most informed trading decisions. Because at the end of the day, that's what trading is all about. It's about being smart. It's about putting as many factors in your hand as you possibly can so that you can make informed trading decisions that ultimately make you percentage, that make you or make you money. So again, just hit your charts, start studying this stuff. Again, if you're the concepts of internal versus external range liquidity or structure, or even just basic supply and demand zones are still a little bit fuzzy as we've gone through all of this. I'm trying to build on everything into a convenient package as we continue. And as we're building on, I'm trying to add everything in so that you can see that they all do work in hand. So if there's an area you don't understand, I strongly encourage you going back to the previous videos, studying them so that you can understand, because everything just continues to build on from here as we continue on.